Welcome to the Ring of Knowledge, your trusted source of financial and practical knowledge. Are you tired of the endless search for the ultimate passive income source? Do you want an investment strategy that can provide a reliable stream of income with the potential for growth? Look no further than dividend investing. In this video, we'll explore the exciting world of dividend investing and provide you with everything you need to know to get started. From understanding key metrics to evaluating dividend stocks to the benefits and drawbacks of this investment strategy, we'll cover it all. But before we dive in, let's bust the myth that passive income requires no effort. While dividend investing can be an excellent source of passive income, it still requires careful research and attention to your portfolio. So are you ready to learn how to get started with dividend investing? Then join us as we explore dividend investing. Everything you need to know and how to get started. What is passive income? Passive income is a financial strategy that allows you to earn money with minimal effort on your part. It's the concept of making money while you sleep, where your income streams work for you without requiring your constant involvement. While this may be true in many cases, it's not the case for every passive income source. However, it's essential to understand the fundamental concept of passive income. Yet there is a common myth surrounding passive income that needs to be dispelled. Many believe that earning passive income is effortless, and anyone can generate it over a weekend. Once set up, all you have to do is sit back, relax, and watch the money roll in. The truth, however, is that passive income requires a significant amount of work up front. You need to dedicate time and effort to set up and establish your passive income streams. And even after that, it needs regular maintenance to keep it running smoothly. For instance, blogging is an excellent example of a semi-passive income stream. It can generate a considerable revenue stream, but it requires a lot of effort upfront to create content and establish a readership. Additionally, even after reaching a steady level of income, you still need to manage and update the blog regularly, which requires time and effort. In essence, it is semi-passive, but not entirely passive. But the good news is that with dividend investing, you can generate genuinely passive income with little to no effort. When investing in dividend stocks, all you have to do is buy and hold the stock, and the dividends will automatically be paid out to you on a regular basis. What is a stock dividend? A stock dividend represents a unique form of payment to shareholders, one that differs from the conventional method of receiving cash dividends. Instead of remitting cash payments to its shareholders, a company may choose to allocate additional shares to its existing shareholders as a stock dividend. This is to say, if you're a shareholder of a publicly traded company that elects to distribute a stock dividend, you will receive an allotment of shares rather than a wad of cash. In essence, stock dividends are paid out in fractional proportions based on the number of existing shares held by each shareholder. Let's take the example of a hypothetical company that declares a stock dividend of 5%. For each share held by a shareholder, the company will issue an additional 0.05 shares as part of the dividend payment. Thus, a shareholder who owns 100 shares will receive an extra 5 shares. It is important to note that the additional shares may not have the same value as the original shares, as the stock price could fluctuate. The dual benefit of dividend stocks: steady income and capital appreciation. Dividend stocks are a unique investment option that offers not only steady income, but also the potential for capital appreciation. These stocks are, after all, stocks, and as such, they tend to increase in value over time. This dual benefit makes dividend stocks an excellent choice for investors seeking a reliable source of passive income that also grows their investment over the long run. To better understand this, let's take a look at a real-world example. Consider Pepsi, whose stock currently pays out a dividend of nearly 3% per year. At present, the share price is around $172. However, if you had purchased the stock 10 years ago, you could have done so at less than $65 per share. Over the past decade, the value of the stock has more than doubled, and you would have earned a steady 3% in passive income over that time. This is a clear illustration of how dividend stocks offer the best of both worlds, providing a regular income stream while also benefiting from potential growth in the stock's value. By doing so, dividend stocks can help protect your investment from inflation and ensure that it grows over the long run, making them an excellent choice for building the foundation of your portfolio. In fact, dividend stocks can often recommend as a core investment, even for investors who also own other types of investments. What is dividend investing? If you're an investor seeking to generate passive income from your portfolio, then dividend investing is an investment strategy that you should take a closer look at. Essentially, dividend investing involves purchasing stocks that pay out regular dividends, which can provide a reliable source of income for investors. To start, you'll want to put together a list of stocks with high and stable dividend payouts, and then undertake a thorough analysis of each company to assess their suitability for your portfolio. By focusing on dividend stocks, investors can benefit from the potential for regular cash flow. Dividend rate versus dividend yield. Dividend rate. Dividend rates are a critical metric for investors seeking to understand how much income they can expect to receive from their investments. This rate represents the total combined dividend payments expected from stocks, funds, portfolios, or other investments, generally expressed on an annualized basis. However, it's worth noting that additional dividends that are not recurring may not be included in this figure. Unlike percentages, which are often used to express rates, dividend rates are expressed as an actual dollar amount per share that an investor receives when the dividend is paid. The rate may be either fixed or adjustable depending on the company. Dividend yield. Unlike the dividend rate, which is expressed as a dollar amount per share, the dividend yield is quoted as a percentage. This is calculated by taking the annual dividend, dividing it by the share price, and then multiplying that number by 100. However, it's worth noting that the calculation for dividend yield presents some challenges. Dividend yields can vary significantly, and the calculated yield may not necessarily reflect the future rate of return. Additionally, dividend yields are inversely related to the share price, so a rise in yield may not necessarily be positive if it occurs due to a sharp decline in the company's stock price. Despite these challenges, the dividend yield is still a widely used metric for income investors seeking to compare different income-paying assets. A company that pays out dividends at a higher percentage of its share price is generally offering a greater return for its shareholders' investments. While the dividend rate is expressed as an actual dollar amount, the dividend yield provides investors with a more efficient way to earn a return on their investment. It enables them to compare different income-paying assets and determine which will provide the greatest return on their investment. The benefits of dividend issuance for mature companies. Dividends are an essential component of investment income, and many mature companies with stable earnings choose to issue them. Let's explore the benefits of dividend issuance for companies and their investors. Firstly, dividend issuance is a great way to attract investors who are seeking a steady stream of income. These investors tend to prefer companies that issue dividends, and therefore, a company that does so is more likely to draw their attention. By issuing dividends, companies can gain access to a wider pool of investors who are looking for passive income. Secondly, a dividend payment can serve as a positive signal to investors about a company's strength and financial stability. When a company issues dividends, it shows that it has positive expectations for its future earnings and that its management is confident about the company's future prospects. This, in turn, makes the company's stock more attractive to investors, leading to an increase in demand and share price. Finally, paying dividends is a clear demonstration of a company's financial strength and its willingness to provide steady dividends to its shareholders over time. By doing so, the company sends a powerful message about its performance and future prospects. Pros and cons of dividend investing. Dividend investing can be an effective strategy for those seeking to build long-term wealth and generate a steady stream of income. However, like any investment strategy, it has both its advantages and disadvantages. Here are some of the key pros and cons of dividend investing. Pros: compounding returns. One of the most significant benefits of dividend investing is that it allows compounding to work its magic over time. By reinvesting the dividends received, investors can accumulate more shares, leading to increased dividend payments and long-term capital appreciation. Stable income. Reinvested dividends provide a solid base of capital for generating income. Over the long run, dividends are much more stable than earnings or cash flow, providing a reliable source of income for investors. Capital appreciation. Dividend investing can also provide capital appreciation. Dividend stocks tend to be less volatile than non-dividend paying stocks, which can help investors avoid significant losses during market downturns. Cons. Limited income potential. Dividend yields tend to be in the 2 to 3% range, which means investors need a substantial amount of capital to generate an income they can live on. This can be a significant drawback for those looking to generate a high level of income from their investments. Limited growth potential. Since any money paid out as a dividend is not reinvested in the business, too generous dividends can be a red flag that the company behind them has little room to grow. This can make it a suboptimal bet for younger, more risk-friendly investors who are looking for higher growth opportunities. Vulnerability to interest rate changes. Dividend stocks can also be vulnerable to interest rate changes. When interest rates rise, the appeal of dividend stocks can decline as investors may shift their capital to other fixed income investments. And that's a wrap on everything you need to know about dividend investing. By now, you understand the potential benefits of this investment strategy, the key metrics to evaluate dividend stocks, and the advantages of dividend issuance for mature companies. As we've discussed, dividend investing can offer a reliable source of passive income with the potential for growth, making it a great option for investors seeking to build a well-rounded and robust portfolio. We hope this video has been informative and helpful in your journey to becoming a successful dividend investor. Don't forget to like, comment, and subscribe to our channel for more valuable financial and practical knowledge. Thank you for tuning in to the Ring of Knowledge, your trusted source for all things finance.